Right. Good evening, everybody. We're going to go ahead and get started. Welcome. I see a lot of familiar faces on or familiar names on the presentation tonight and a lot of new ones. So, for those of you who are new, welcome. And those of you who've been on our presentations before, welcome back. Just a little bit of refresher. My name is John Mantilla. I'm the CEO of Parco. I have my teammate Lauren Fulcher also joining us on the line tonight. And our company Parco specializes in retirement and financial planning for anybody with a pension, but especially government employees. And we work with federal employees across the country and around the world, no matter what stage of the career that you guys are in. It could be somebody just starting out and wanting to make sure they're taking full advantage of all the benefits offered to them as federal employees. Some folks in the middle of their career wanting to make sure that they're positioned the right way given life changes, marriage, kids, things like that. And then more and more folks that are approaching the end of their careers wanting to make sure that they're positioned in the right way to enjoy those golden years that they've planned for many of you 2, 3, even 4 decades for. So we work with folks at every stage of the retirement and financial planning path. And our whole goal is to take all the uncertainty and all the confusion that can come with this time period in your life and with thinking about these things and make them really simple, straightforward, and easy to understand. And so, especially given that it's the end of the year, um, a topic that's coming up a lot right now, especially as we're approaching the beginning of the new year, is RMDs, required minimum distributions, and Roth conversions. So, there's a couple things to know. We're going to go through the different types of investment accounts tonight. We'll talk about the different growth and contributions and kind of those dynamics. We'll talk about required minimum distributions, Roth conversions. We'll go through a simple example, and then we'll talk about how to get started. Now, throughout the presentation tonight, you will see QR codes. You can scan those. Also, within the chat window, I've sent a link to our platform, app.goparco.com. At any time tonight and after the presentation, you can create your account and schedule an appointment right through our platform to go through all of the things that we're going to be talking about in general as it applies to your specific situation. So we know a lot of folks have been asking for that, and so we've made that really available to you all because we know um, this is important. So without further ado, let's go ahead and dive right in. So first, it's important to understand the different types of investment accounts. We notice a lot of confusion around this, and so we want to make sure we start by kind of going through the different types of investment accounts. There's three different types, main types of investment accounts, and it depends on how they're all of it comes down to how they're qualified for taxation. So starting first with sort of like the classic or the list of these accounts, these are non-qualified accounts. So this is money in a checking account, a savings account, a brokerage account that you have at Charles Schwab or Fidelity. This is non-qualified money. So you fund this with dollars that have already been taxed, and then money within this account is subject to taxes on dividends, interest, and realized capital gains. Where can they be held? They're typically held individually. So you'd have your own bank account with Navy Federal, or you'd have your own brokerage account with, like I said, Fidelity or Charles Schwab or whoever it is, Robinhood. So they're individual accounts. And non qualified accounts do not have any statutory required minimum distributions. So that's kind of like just a simple, regular old run of the mill account. Then there is traditional accounts. So the next two types of accounts, the traditional and the Roth, these are special qualifications, particularly for retirement savings. So traditional accounts are funded with pre-tax dollars. This means that they are funded with dollars that have not been taxed. And then usually you contribute to during your career. And then when you take money out of that account, any withdrawals you take out of that account are taxed as income at that point in time. You can have traditional accounts with your employer, so it could be a 401k or your TSP. You can also have an IRA, which is an individual retirement account, and that would be outside of your employer. And traditional accounts do have required minimum distributions, which we'll talk more about what that means here in just a few bits. Then there's Roth accounts. So they're a little bit newer. They haven't been around as long as traditional retirement accounts. But Roths are funded with after tax money, meaning dollars that have already been taxed. But when you take withdrawals from these accounts, there's no taxes due. There's no income tax due, dividend, interest, capital gains, no taxes due at all. You can have a Roth 401k, a Roth TSP, a Roth IRA, and Roth accounts are unique in that they don't have required minimum distributions. So that's sort of like the high level about each of these different types of accounts. So when people are thinking about choosing between a traditional and a traditional, like I mentioned before, is funded with pre-tax dollars. So what does that mean? You put money in, let's say while you're working, then let's say you put that in the S&P 500 or the C fund. The money in that account grows. All the growth that happens in that account is tax deferred. And then when you do take money out of that account, you'll pay taxes on those withdrawals. Take $1,000 out of a traditional account in retirement, that $1,000 counts as $1,000 of income for you, and you owe taxes. With a Roth, you pay the taxes before you put the money into the account. So it's funded with dollars that have already been taxed from the IRS's perspective. Then all the growth gains and interest in those accounts is tax free. And then when you take money out of those accounts, you don't pay any taxes on those withdrawals. Now, with traditional accounts, with Roth accounts, you can have them at your employer or you can have them individually. So if it's an employer sponsored account, be it a 401k or a TSP, or for some of you, maybe your spouse is a 403b or other similar types of accounts, they have different contribution limits, meaning how much you as an individual can put into those accounts every year. So for 2026, those contribution limits are $24,500 plus an $8,000 catch up for employer sponsored accounts. For IRAs, the contribution limit is $7,000 with $1,000 catch up for those who are over age 50. That's where the catch up kicks in. Now, for IRAs, not for 401ks, not for TSPs, there is and there are earnings limits, meaning that if you make more than a certain amount of money, you can't contribute to an IRA. So for 25, the earning limit for a single individual to contribute to a Roth or to an IRA was $150,000. So if you made less than that, you could definitely contribute to a Roth or to an IRA. If you made between 150 and 165, you could contribute, but not as much. And if you make over 165, you're not allowed to contribute to an IRA. If you're married, the limits increase to these amounts. 236 if you're as a couple married, make less than that, you can contribute to an IRA. If you make between that, you can, but on a sliding scale. And then if you make more than as a household, $246,000, you're not allowed to contribute to an IRA. And just as a reminder, if you have questions tonight, you can ask them in the chat window or in the Q&A window. We'll be happy to answer them. So those are some of like the high level details about Roth, traditional, and non-qualified accounts. Now we get the question all the time about, hey, I'm going to contribute to a Roth because I'm never going to be subject to any taxes again, and that makes the most sense. We have other folks that tell us, hey, I'm going to contribute to a Roth, or pardon me, a traditional account, and that makes the most sense because I'm deferring taxes. And sometimes people think there's going to be like some magic growth factor because they're picking one or the other. Well, one thing we like to mention right off the bat is that if tax rates were flat, meaning like, let's say we had the old Steve Forbes flat 20% tax rate for income for all Americans, your money in a Roth or traditional wouldn't matter. So let's say a 20% tax rate, you were contributing $5,000 a year over 20 years, and there was no growth. So we're just focusing on the tax consequences. If you put money in traditional, let's say you set aside $5,000 out of your gross salary. Well, for a traditional account, all of that's going to go into that account, whereas for the Roth, we'd withhold 20% for taxes. So at the end, the traditional balance, if there was no growth over 20 years with $5,000 a year of contributions, will be $100,000 on a gross basis. The Roth would be $80,000. However, the traditional would have an embedded tax liability of $20,000. So the net ending value for you would be exactly the same. So we always like to point that out. It's not like there's any sort of like magic compounding that happens because you have more dollars sitting in one account than the other. As if tax rates were the same, the ending value is exactly the same. So when people ask us what's better, traditional, it really comes down and depends on your tax bracket. And ultimately, like what matters most is how much you save, more so than where you save. So think about like the dynamics of a traditional account. The reason why people like using traditional accounts is that usually while you're working, you're in a higher tax bracket than you'll be in retirement. And so if you um, have money in a traditional account or you're contributing to a traditional account, you're basically deferring taxes from a period in your life when you're in a relatively high bracket while you're working to a period in your life when you're in a lower bracket in retirement. So that's why some people like the traditional. However, then they have to plan about, hey, there's going to be tax implications on these withdrawals when I retire. With a Roth, there's you're already paying the taxes up front, so you're kind of like locking that in, but then you never have to worry about income taxes again on that money. And so for some people, that's dispositionally attractive because within a traditional account, we're just using this as an example. If you look at your TSP traditional, let's say, or your IRA traditional, and you have, say, $400,000, well, some portion of that account isn't yours. Some portion of that is an embedded tax liability that you'll eventually have to pay to the government. Whereas with a Roth account, even if the net value is maybe lower, all of that account is yours. So those are some like the dynamic of those two types of accounts. But I will tell you, we've worked with thousands and thousands of people. The most important thing is not whether you choose traditional or Roth. The most important thing is how much you save. So, for example, let's say that this is just kind of like the magic of compounded growth. Say you made $80,000 a year, you had 5% annual growth, and you just contribute 1%. Okay, over 1 year, your account's at $840. Over 20 years, your account will be over $27,000. If you just double your contributions from 1% to 2%, your ending account value is well, it's basically double. It's basically double. So, basically double. So, that has a much bigger impact than whether you picked paying the taxes now or deferring them into retirement. So, the folks that we work with that are always in the best shape for retirement are the ones that get this part right, are the ones that say, hey, I'm going to save 5, 10, 15% if it's possible of my paycheck every month. Um, those are the ones that inevitably are always in the best shape for retirement. Super important. So if you find yourself getting turned up at work because you're debating somebody about, oh, Roth's better, traditional's better, what matters most is how much are you contributing. That's going to have a way bigger impact than which account type you choose. So we've talked about the different account types. We've talked about some of the growth dynamics. Now let's talk about required minimum distributions or RMDs. So RMDs are money that is required by the government that you must withdraw from certain retirement accounts starting at specific ages. Now, why are RMDs a thing? Why do these matter? Well, think about your traditional TSP or a traditional IRA. You're deferring taxes, right? You're putting money in there that you haven't paid taxes on yet. The IRS and the government wants to get their tax money. And so they start to require you to take money out of those accounts and put it into your bank account. And so take it as a withdrawal, and that realizes the taxes for you. Now, RMDs start or can start depending on the age that you are, and your RMD age is based on when you were born. So anybody born before 1950 has already reached their RMD age. For those folks born between 1951 and 59, your RMD age is 73. If you were born in 1960 or after, they just raised this is to 75. Now, I'll say when we first started, the RMD age was 70 and a half for pretty much everybody. And they've been gradually raising it as folks have gotten older. Obviously, COVID impacted this as well. So it's not outside the realm of possibility that they could keep raising it, but this is how it is right now. So RMDs are based on your age. And then the amount that you have to take out of your account is also based on your age and what's basically they use a factor. So some of you who maybe have researched this before, if you've gone onto the IRS's website, you may have seen a table that looks like this, where they'll say, hey, based on your age and your distribution period, that's how you'll calculate your RMD. And you might look at this table and you're like, I have no idea what these numbers mean. And I don't blame you because it doesn't make a whole lot of sense to me either, the way they express it. But what it actually means is basically if you invert these numbers, it tells you what percentage of your account you need to withdraw every year based on your age. So, for somebody who's 72 years old, for your traditional accounts, you need to distribute 3.91% from those accounts, and that's your. So when you're trying to calculate your RMD, you take your account balances for your traditional accounts on 12/31 of the previous calendar year, and then you divide that by the distribution period. And that's how you calculate the RMD. We think it's a lot easier to just convert that into a percentage and to say, hey, look, if you have $348,176, we need to take out 3.91% of that. That's $13,600. That's going to be your required minimum distribution for the year. So either method works. I just have found that when working with folks, the latter is a lot more intuitive than the former. So some folks will ask us too, hey, what if I don't take an RMD? I don't want to. Like, who's going to tell anybody? How are they going to know? Well, the IRS puts pretty intense penalties on folks if you don't take that RMD. So if you don't take an RMD, they will levy a 50% tax on the amount that you should have distributed but didn't. So pretty strong disincentive to not take it. And so the challenges with RMDs is that you might say to yourself like, John, who cares about this? Well, maybe you don't want to take that money out. Or maybe you like the fact that the money in your traditional account is growing tax deferred, and you've got a pension and you've got social security and you don't want this extra income. Maybe you're trying to leave this behind for your kids, and the government basically requires you to take that money out. And when you take an RMD, it has to go into a bank account, so it can't go into another special tax qualified account. It has to go into a non-qualified account. So it can be really challenging. And so some people will say, well, look, maybe I can get a penalty waived or I can waive my RMDs. There's ways to do that, but those situations are kind of few and far between. So, you know, a lot of accounts have these RMDs, basically anything with traditional money, 401k, 403b, 457, traditional TSP, traditional IRAs. Maybe you have a SEP or a profit sharing plan. The only type of accounts that don't have RMDs are Roths. And so when you think about the planning, maybe you're 60 or 64, think about retiring soon. Look, I know I got this traditional balance. I know I'm intending to retirement. I don't need to use a lot of it. And I'd like to get it into as vehicle as possible by the RMD age. Can I do? Well, there's a process that you can do that we help our clients with called Roth conversions. Some of you may have heard of this, some of you may have not. But it's the process of gradually converting your traditional balances into a Roth. Now, Roth accounts are unique in that they do have a couple rules that you have to follow. So you need to be over age 59 and a half, and you have to have had the account open for 5 continuous years for that account to vest, meaning that you have access to all the growth gains and interest in that account without any penalties or taxes. So that's why here at Parco, we recommend folks open up a Roth IRA as soon as they can, just to get that 5 year clock started. It's something we help folks with every single day, and you can do it right through our platform too to make it really easy. So they're useful in addition to providing all the financial flexibility that we'll talk about here. They're particularly useful for legacy planning. And why is that the case? So let's say that your kids inherit your traditional IRA. Well, that's a lovely thing to inherit. However, your children will have to withdraw that entire account over a 10-year period or within a 10-year period of inheriting it. And what that can do, especially if it's traditional money, is if they take withdrawals from that account, that can push them into a higher tax bracket. So they may inherit, let's say, $250,000 traditional IRA. Well, after taxes and everything, maybe they only get to walk away with $150,000, $160,000 of that money because usually kids who inherit traditional money are working still. Maybe they have a young family. And so if your kids and your legacy planning is important, it's always better for beneficiaries to inherit a Roth because they have the same requirement to take those withdrawals within 10 years, but there's no tax implications to that withdrawal. So they could wait till 9 years, 11 months, and 29 days, then take the Roth out all at once, put it into their bank account, and there's no tax implications. So as a beneficiary, you'd always rather inherit a Roth because it just gives you a lot more financial flexibility. And so this is why so many people that we work with, it's one of like our core things we help people plan for is Roth conversion, where you gradually move money from your traditional IRA, traditional 401k into a Roth. Typically, people will wait to do this until they retire. Now, why does that make sense to wait until you retire? Well, think about it. Let's say you're working and you're in a relatively high income tax bracket. Maybe you're a physician at the VA, or you're in the DOD, or you're at the post office and you're making good money because you've been there for 20, 30 plus years. In retirement, on a net basis, your financial position might not change, but from a tax basis, your position might change a lot. And so you'll be in likely a very low bracket compared to where it is where you're working. And that gives you a lot of room to do Roth conversions. It can be a lot more tax efficient, meaning more money gets from your traditional account into your Roth rather than having to have it go through the tax man. The critical reason why this strategy works is that there are no limits to Roth IRA conversions and Roth conversions. So remember how earlier we talked about how there were contribution limits to Roths? There's no limits on conversions. So, in summary, they allow for withdrawals with no tax consequences. They create a tax free inheritance for heirs, and they can materially reduce your balances that you have that are subject to RMDs. So, let's take like a very simple example. Let's say Sally's retired. Okay. This is a very actually typical example for a client that we would work with for a federal employee. One of the unique things about being a federal employee is that aside from having fixed income from Social Security, you also have fixed income from your pension. So we know that there's basically like a floor to your guys' income. And so in somebody like Sally's case, let's say that her gross income is going to be $60,525 a year. And let's say she doesn't really need or plan to touch her traditional balance at all. Well, we look at the tax bracket that she's in. She's a single woman. And we say, well, look, Sally, you might as well convert $25,000 this year to get you up to the top of the 22% bracket that you're in to get money into Roth. Because what will happen is over time, you'll gradually winnow down your traditional balance and gradually build up your Roth balance. That way, by the time that you hit age 72 or 73 or 74, 75 in our case, 75, the amount of your balance that's subject to RMDs might be might be zero, or at least much lower than it would be otherwise. So that's kind of like the simple strategy that we it's simple for us because we do it all the time, but it's one of those things every federal retiree should be evaluating every year to make the most of the assets that they've saved for a lifetime. So when it comes to getting started, you know, a couple of things. Next week we're going to be doing our end of year housekeeping webinar. So be looking out for that. But if you'd like to get started, we'll be answering any questions about the presentation tonight in the Q&A window. But you can set up your account on goparco.com and go right through our portal and our platform and set an appointment, and we'll happily help you strategize for your Roth conversions. It takes a little bit of effort to make sure we get them right, but it's a super important strategy that we have a lot of folks we're working with now that have already begun down that path, and by the time they hit 72 or 75, depending on the year they're born, they they very well very will likely not have any RMDs, but you kind of have to get started on that planning early. So, anyway, as always, it's a pleasure to present to you, and I'm looking forward to answering any questions that you all have. Like I mentioned before, I'll send the link again just so it pops up in the chat window to our platform. And we'll wait around to answer the questions that y'all have. 'Cause I know these Roth conversions can be kind of a confusing topic. Oh, thank you. Okay, so Thomas asked a really good question. How old is reasonable to start a Roth? I just retired at 64 with good investments, but none of it in Roth. So, Thomas, what I would recommend you do if you retired just now, I would definitely open up a Roth IRA before the end of the year. You can open one with us through Charles Schwab. You can open one with Fidelity. Open one right now just to get that vesting clock started. Then, when it comes to Roth conversions, especially if you just retired now, I don't know all of your details, but if you're planning to be retired next year, I would start Roth converting next year. Usually, it's a conversation we have with folks toward the end of Q3, the beginning of Q4, to say, "Hey, look, between your pension, Social Security, distributions from an annuity or from your 401k, how much does it look like your income is going to be as a household?" And maybe that number is $100,000. Then we'd say, okay, if you're married and your gross income is going to be about $100,000, how much room do we have in that bracket that you're in? And then we'd recommend you convert up to that amount just to start. And then some folks say, hey, look, I'm in the 22% bracket now. I don't know if the 24% bracket's going to be around. I'll go all the way up to the top. That happens all the time. Um, that happens all the time. Does that make sense? Usually people do Roth conversions though in retirement. Um, that's by far the most common. So Sharon has a really good question. She just wants to know like kind of more about us and how we operate as a business. So our company does financial planning and retirement planning and investment management for folks. So we help people. We charge for wealth management. We charge what was it, 0.25% per quarter to manage people's money. We also help people plan out their life insurance, plan out their income. We can help people get mortgages or refi mortgages. Basically, our vision is that a federal employee is most middle class Americans have to balance so many different things, right? You guys have, you know, all the stuff going on with the federal government and all your complex retirement and financial benefits that you have through your employer. And then on top of that, you have to balance all the stuff that every American has to balance. Social security strategy, investment strategy, you know, debt strategies, mortgage strategies, things like that. And so we said, look, what if we offered all of that in one place? So you weren't having to explain your situation to one guy and then had to explain to the next guy, and none of them talk to each other. We said, well, look, what if we can have a 360 view of our clients? How great of a product, how great of a experience could we deliver for them? And so that's what we've built. So we never charge for any of our federal retirement planning calls or helping people plan out their retirements or anything like that. But if there's something that you need, we can offer it. We'll recommend it. But it's always an offer. Hopefully that answers your question, Sharon. Oh, good question. So uh, there's a question that says, I'm working still, but I'm 73 years old. I'm planning to retire next year. Do I need to take an RMD from a 401k? So if you are working, you don't have to take the RMDs. You get there's a special waiver for RMDs while you're working. Now, when you retire, given your age, you'll have an RMD starting that following year. Um, and it'll be based on your age at that point in time, but you don't have to take those while you're working. All right. Hopefully that was helpful, Guillermo. Next question from John. I'm taking my RMD for the first time this year. I have a TSP traditional and a small IRA with Schwab. Can I take a single RMD that covers the amounts for both my TSP and my Schwab? Or do I need to take the RMD separately? That is a great question. So it's kind of weird. The IRS um, considers employer sponsored retirement accounts like the TSP as different than IRAs from a RMD perspective. So what's kind of weird about that is that you have to take them separately. So short answer. However, what's weird, the reason why I say it's weird is that if you moved your TSP into an IRA that was not the IRA that you already have at Schwab. So let's say you had two separate Schwab IRAs, which you could do. It happens all the time, actually. Then you could take all of the RMD from one IRA. So hopefully that makes sense, John. But like the they basically look at your accounts and say, well, how much is in 401k assets or employer sponsored assets? Okay, there's an RMD for that. How much are individual? Okay, there's an RMD for that. And so if you move the money from the employer sponsored account into an individual account, then suddenly you have a lot of flexibility on where you pull the RMD. Joyce asks the next question. I would like to open a Roth account next year and convert my RMD money into Roth. How can I open a Roth account? So, Joyce, when you set up an appointment with us, we could actually get you a Roth account opened up by end of week or beginning of next week. And you could fund it with, you know, just a couple dollars, like $100, just to get that clock started. Next, this is a really good tip. I probably should have put this in the presentation. Anybody who doesn't have a Roth IRA open right now should open one right now, and just fund it with as long as you can contribute to one. Fund it with some nominal amount of money because the way they look at the vesting for Roths is based on calendar year. So if you open up a Roth IRA on January 1st or on December 30th, that counts as 1 year. And then when January 1st of the next year rolls around, that counts as the second year. So if you opened a Roth IRA on 12/30 and then we're sitting here on New Year's morning, that you, from the IRS's perspective, you've had that account open now for vesting requirements for 2 years. So it's a good little trick. It's not based on like a anniversary date or anything like that. Great question, Joyce. And we could set up a time to do it with you probably this week. Lauren, if you want to reach out to Miss Joyce to help her with that, we can do so. Paul asks for the special RMD waiver if you're still working. Is there some income requirement or hours worked requirement to qualify for that? That is a good question. Paul, I will have to check on that. I will have to check on what the requirement is on that. I'll have to check. Um, Lauren, if we write down Mr. Hessler's question, we um, we can uh, we can email him with an answer. Because Paul, I want to give you a good source on that. Keep those questions coming. So another question is, I live in Maryland. Can I meet face to face? We work with clients across the country and around the world. Main office down here in Richmond. We also have teammates in St. Louis, but we meet with all of our clients now virtually just because federal employees are in every state and in pretty much every country. So occasionally we'll go up to Maryland for presentations and things like that. But if you'd like to meet with us as soon as possible, it's going to be through Zoom or Teams or Google Meet or whichever platform you like. A lot of people start to really like that because they do it from home in their PJs, which you would be surprised happens quite a bit. But great question, Joyce. Thank you. John, the answer to your question is yes. You can use money from your TSP to pay for the new Roth IRA. As long as you are working, that can count as a contribution. Otherwise, we would do that as a conversion. Sandra asks, when I do a Roth conversion, should I open a new account each year or do it all to the same account? Do it to the same account. Do it to the same account. The key thing is just to have an account, a Roth account open. The key thing is just to have a Roth account open. So everybody that we work with goes their Roth conversions into the same account each year. And it's a conversation we have with them every October, November, early December. Really good question, Sandra. So Darnice says, I would like to convert my RMD money into a Roth. Do I have to wait 5 years before I withdraw? So Darnice, about how old are you right now? That would be a helpful data point here. Um, but you can't convert money from an RMD into a Roth. That's like one of the big things is that if you take an RMD, that money has to go into a non-qualified account that we talked about. Checking account, banking account, or savings account, brokerage account, things like that. So those can't. That's the challenge with RMDs. If RMDs could go into a Roth, it wouldn't be a problem. Be like, okay, you're forcing me to put money into a Roth. I'll pay the tax. It's no big deal. But the IRS says no. RMDs have to go into a non-qualified account, and that's why a Roth conversion is so important. Um, what I think maybe I could clarify on though is that for the Roth account, it only needs to have been open for 5 years and you'd have to be over age 59 and a half. It's not based on the timing of your contribution. So what do I mean by that? Let's say you've had a Roth account open for 10 years and you do a big Roth conversion one year and you put $100,000 into a Roth account, into that Roth. You can take money out of that Roth one day later if you want without any tax implications. You don't have to wait 5 years for that tranche of money to vest. It's based on the age of the account itself. So, Darnice, your question actually unlocked a couple good extra questions. Da, 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 da. Okay, so Paul asks, following up on the specialty waiver, if I start taking my age-based RMD and then decide to go working, does that interrupt or postpone subsequent R&Ds? That's a good question, Paul. I don't know how they handle folks that leave, that are taking RMDs and then start working again. I don't know the answer to that. I think I'm gonna have Lauren write that one down too, and in our email to you, we'll give you some straight answer on that. All right, Sandra S. When I do a Roth conversion, I must wait 5 years to withdraw. No, no. So as long as you've had the Roth account open for 5 or more years, you can take money out of it at any time. So let's say that you've had this Roth account open for 7 years, and you do a Roth conversion of $15,000 from your traditional IRA, traditional TSP into your Roth this year. You can take that $15,000 out, no problem, at any time from your Roth without any penalty because you basically unlocked that Roth because it's been open for more than 5 years and you're past age 59. It's a great question. Joyce asks, is there going to be a direct deposit into my Roth account from my TSP account, or should I put it? I imagine probably as like a withdrawal. What most people do is they do to do a Roth conversion into a Roth IRA from TSP. What most of the folks we work with do is they'll move money from their traditional TSP into a traditional IRA at, say, Charles Schwab. Then later that day, a minute later, they'll do a Roth conversion from that IRA, that traditional IRA, into a Roth IRA. That generally tends to keep things cleaner from a audit trail perspective. And it's something we help folks with every single day. So uh, John asks, if I have a TSP Roth, can I transition the entire amount to a non-TSP manager, say at Charles Schwab? Are there disadvantages to doing this? So the first answer to your question is yes, you can do that. We work with a lot of folks that do that. The one thing I would say to be aware of is that if you, let's say that you don't have a Roth IRA opened anywhere, and you do, let's say you don't have a Roth IRA opened anywhere, and you take money out of your traditional TSP or your Roth TSP and move that into a Roth IRA, and it's like a fresh new Roth IRA, the vesting period does not carry over. So that's one thing we'd always want to be really careful about. Becky mentions that yes, and or Rebecca mentions that yes, starting in 2026, the TSP is actually going to allow you to do Roth conversions inside of the TSP itself, which we know a lot of people have been wanting to do too. So a lot of 401k plans have been becoming more accommodating to the Roth conversion strategy because so many people want to do it, and TSP is following suit. So starting next year, you'll be able to do Roth conversions inside the TSP. You'll still probably want to wait to do that till you're retired, but it's another arrow in your quiver. Thanks, Rebecca, for bringing that one up. Keep those questions coming, y'all. Of course, if you don't have any more, I don't want to force you to ask questions. But this is now's a great time to do it. Well, hopefully you all. Oh, there we go. So Sandra asked just like, how do I keep straight about the amounts that I know to take out if I do a Roth conversion? So as once you hit the 5 year mark, meaning that once you've had the Roth IRA or the Roth account open for 5 years, there's nothing you need to keep track of. Any amount that you contribute in after that, you can take out at any time. Any amount that you've contributed up to that point in time, you can take it at any time. It's just as long you just had to have the account open for 5 years. All right. Well, I don't see a whole lot more questions coming in. Um, as always, it's a pleasure to present to you all. I see that some of you are even starting to create your accounts and everything like that. Um, One of the things that we'll mention as well is that next week we're going to be doing a presentation about uh, end of year sort of like financial housekeeping, things like opening up a Roth IRA, funding things that need to be funded. There's a question about qualified charitable contributions and RMDs. Um, John, I think that that would be best suited for our next webinar, especially given toward the end of year, like kind of like tax planning. But we'll add that to our list for next week. Um, I'll add that to our list for next week. Uh, don't let me forget, Lauren, for the qualified contributions. But we know with the holidays and everything coming up quickly, there's a couple low hanging fruits that some of you might need to do before 12/31. And so we're going to be covering that in our webinar next week. So as always, great to see you all. We hope you all have a really, really great rest of your week. Stay warm. I know it's supposed to get really cold in different parts of the country. And we'll see you all. As always, the accolades and the compliments are always super appreciated. So have a great evening, and we'll see you all next week. Be well.